Okay, today we're going to talk about rejection blocks. Okay, rejection block is basically a form of liquidity, okay, and it's a place where we could target our profits, okay. In this case, rejection blocks are the highs of the candles, okay. For example, the highs of the bodies, so I'm more clear. This is the rejection block, okay. This is the rejection block, okay. This right here is the rejection block. As you can see, it never goes for the wick. It not only goes to the body, touches the body right here, continues higher. Okay, that's the rejection block. What's another example of a rejection block? For example, rejection block would be these highs. This is the rejection block. Touches it, also takes the liquidity, but it doesn't really need to actually take fully the liquidity. It could just literally touch the rejection block and then displace lower or higher, depending on what type of market we're looking at. On this case, it does touch this and takes the liquidity. Okay, in this example, it only touches the rejection block. As you can see, it touches the rejection block. This places lower for later on taking full liquidity over here. Okay, let's see more examples. These highs over here, it's all of these ones, as you can see right here. It touches the rejection block, I believe, I'm not quite sure. No, it barely touches it. It does not touch the rejection block on this case. But here we have a perfect example. As you can see, we eventually tap into this liquidity, yeah, but for a while we're just tapping into the rejection block, which is the body of the candle when there's a wick. It's the highest or the lowest where there's going to be liquidity. For example, this will be the rejection block. In this case, it does eventually touch here, but then we have this as our rejection block, and as you can see, in this case, it does not come for this liquidity. It touches the rejection block and then displaces higher. So what's the real point of the rejection block? Rejection block is just for us to know if the market's reaching for liquidity, we want to take profits at the rejection block, and we're cautious. If the market does not respond with immediate downward movement, and let's say it touches a rejection block, in this case this one right here, and then goes up, this respects a bearish that I already explained, a bearish break order block, we can expect a few days of up movement. What do we do next? We take this liquidity over here, then we displace lower. After we disrespect this swing low and the bullish PDR raise, we mark bearish PDR raise, fair value gap, we go lower. That's pretty much a rejection block. Pretty straightforward, pretty basic, and pretty easy if you ask me. Example here. We touch the rejection block, we go higher. Okay, I'm not quite sure if we touch this rejection block over here. No, we didn't. We took this liquidity, but we never came for this right now, so it might be left for later on, right? And last example, just so you grasp it up. Right here, those come for this swing low, and then accumulates and go higher. But in this example, for example, it never comes to the rejection block. I believe here it doesn't come for the liquidity, but it touches the rejection block, as I've mentioned before. It's the lowest body, so in case we have two bodies and one has a little bit gapped below, like it opened right here, we use the lowest body. We touch the rejection block, we displace higher, we disrespect a CB. Right here we have a change, we do not need to wait for this swing high. And then we come down, we accumulate at the bullish order block right here. I don't know what candles are these, they're kind of weird because I'm not quite sure how they opened, but well, it trades down again, then it opens here with a huge gap. And later on, opens again here with a huge gap and trades up, comes to the bullish order block over here, accumulates at the bullish order block again, we displace higher, and I don't understand this kind of price action, what happened on this time period with DXY, but it's kind of weird because it opens, goes down, it opens, then goes down, opens, goes down, opens up here, so it's kind of weird, gapping all the way, like every day gaps, the next day gaps, the next day gaps. But well, over here, as you can see, that's the rejection block. I'm not quite sure if we came for this one right here. I believe it did. It's 56. No, it didn't. But as you can see, this is the big swing low that made the swing high. We never came for this low, so we can target, if we were short, because right here it's very short order low, we can target the rejection block, and that's enough. If it goes lower, better, but if not, we don't want to get our profits into a loss. Okay, that was it, and hope you understood and enjoyed. Well, today we're going to be talking about inverse order blocks. Okay, what's an inverse order block? Well, inverse order block is the same concept that a bullish order block. We're going to use it as an inverse. In this case, we trade up. Okay. Once we trade it up, what is the bullish order block? Well, it will be all the up candles. In this case, I will not use any of them. I will just use this BC. Okay, I will use the BC. We also have this order block, normal order block, which eventually gets tapped right here, as you can see. It gets tapped, and then we go higher. But now here I would use an inverse order block, right? I would use this right here, this imbalance, and also what I'm looking at these order blocks right here. I want to see price respected, because we broke this, we disrespected these down candles, which should support price higher if we were truly bullish, and then we start going lower. What am I looking at right now? Well, first of all, I'm looking at this fair value gap. Okay, and what I'm looking at, this inverse order block right here. Okay, so I don't want to see price go higher than here. we go down again, we go up. Right here, it feels like it's kind of, disrespecting the PDR raise because it's trending above it. We eventually trade down, liquidity, we trade up, trade down, we trade up, we trade down, we consolidate. There's not even a real price. This is just liquidity on lower time frame. Then once we go up, there we go. Where are we looking? We're looking at this imbalance, right? And also, we're looking at this order block, right? We do not want to see price go lower than this order block and this imbalance. Okay? Price continues to go higher. There's no further gaps. Okay, no problem. We just trend higher. Fair value up here. We do not want to see the price trade through it. The higher we go, we have a fair value gap. We have an inverse one. We go lower. Okay, what am I looking at right here? I'm looking at this order block, first of all, the one with the volume. And I'm also looking at this zone, the same we were looking at. We touch it. Once we can show some displacement right here, we can think, okay, we're leaving this range and now we're going to start going down. And you just look for shorts every day looking for shorts. Okay. We go up. Okay. Up, 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 up. What I'm looking at. This run. Okay. Run stops. Perfect. Let's trade through it. Again. Right here. We do not need to wait. Once we trade through it, what am I looking at? This. Perfect. Why? Because this is actually a breaker. It's an inverse breaker. Or we can just call it a normal breaker that's being traded before. We're just predicting this will be used as the price to what? To go higher. Because this was just a run stops. Because the bearish rates are not being respected. This fair value gap and this volume imbalance right here. The volume imbalance, they're being disrespected. Boom. So we can expect price to use this as support. Goes higher. Then we have this imbalance right here. And the actual breaker, in case we hadn't entered. This is the breaker. As you can see, touches the breaker higher. Touches again higher. Okay. Let's go to the lower time frame so I can get more examples. Right here with freight, okay, we consolidate. Right here, we go up, we're starting to follow the bullish PDR raise. So we're looking at this order block right here. For the order block, we go lower and we go higher. We take stop losses right here. All of these stop losses. And then what do? We trade through this value gap right here. After a run stops, what are we expecting? We're expecting price to go higher. Boom. Now what are we using? We're using this order block and there's a little fair value gap right here, which eventually gets tapped right there. Little tap goes higher. We're using what? We're using this breaker. Trades, touches the break, goes higher. Okay. What are we looking at right here? Okay, we're bearish right here. Why are we bearish? Because this order block gets disrespected. Right here it gets disrespected. So once it gets straight through, we're using this as our inverse order block. Okay, we touch the order block, we touch the order block, there's also a fair value gap which eventually gets traded. And we go lower. What are we looking at right now? The order block, which will be this one right here. Okay, this will be our order block. And which are the sensitive points in this order block, especially the body and the half of the wick. Why the half of the wick? Because it's a big wick. Half of the wick is going to be sensitive. We want to see price trade down with it. Goes up, trades down. We also have this inverse order block. Why this inverse? Because we wanted to see all the down candles supported. But on this case, I mean, it's just trades through it. And there's also the 50%, so it's major confluence on the higher time frame. 50%, we went down from a fair value gap. There's this inverse order block. We want to see the rise lower. Now, we have this fair value gap, which we think price should respect, but it just trades through it, then taps into it, goes a little bit higher. What are we looking at? Once we trade through this order block, we only have nothing. There's nothing, no fair values. So we're looking at this fair value gap and this inverse order block. Price trades through it, taps into it again, goes higher. Once we trade through here, what are we looking at right here? What is that we're looking at? Right here, we're looking at this. Basic. We want to see this stop run. They run them. Down. Boom. Run. What else do we have here? We have inverse fair value gap. Once we see this placement, we can see that price is willing to go higher from the fair value gap. So, what is basically this? You see this order block is getting respected outside. So, we want to look for lower time frame confluence. On the 1 hour, I mean, there's no real line entry, but on the lower time frame, you can get something. Okay, right here there's no entry in the 1 hour. Let's go now to this price action. Here is a consolidation, so it's kind of hard to determine. But what I do like is this. We're disrespecting the bullish PD arrays, as you can see. Trending lower. What do we have here? We have this fair value gap. We tap into it, then it displays lower. Perfect. We trade now. Where? We never took this, or did we? Yeah, we did. We trade now. We up. Okay. We disrespected this, so we would want to see the price eventually. You know, once it traded up, we want to see then price go higher, where to the stop losses at least. But it never does it. It never goes to stop losses. It just goes lower. So now the price goes lower here on this candle at 9. Where are we looking? At the order block right here, which eventually becomes a propulsion. Why? There's an order block right here. There's a fair value gap right here. We trade through the order block, then we trade again to the order block. This becomes our propulsion. Like it tells you, order block gets tapped, gets traded through, tapped again. That's our propulsion. Propulsion goes lower, manipulates higher on the news. Okay. What are we seeing here? We see this order block kind of working, but once the price trades through the order block, okay, once the price trades through it, just like here, with thread. So this order block to be what? First of all, a breaker, and second, also a inverse order block, right? So that was pretty much it. Maybe confusing, but when you do not have any PD array, it's a nice way of looking for a PD array. However, my preference is just looking for normal PD arrays such as fair value gaps, volume imbalance, inverse volume imbalances, and breakers and everything. I'm not really into inverse order blocks and inverse fair value gaps and everything, but whenever you do not have any array, it's better to have these inversion places so you can determine where is likely. Also, what are their use in my experience? Their use in my experience is invalidations. For example, our invalidation right here will be, okay, once we see price straight through this imbalance and through this order block right here with big displacement, what are we thinking? Okay, first of all, this is a BPR. Okay, BPR, like I already taught you. It touches the BPR, this place is lower. Okay, so BPR, we go down. Nice. Okay, we go down, and also we have a volume imbalance right here. But this becomes also an inversion. Okay, inversion fair value gap and inversion order block. But in this case, it's just, in my opinion, better to have them as confluents. All the bullish arrays that were disrespected on a bullish trend now become bearish arrays, so you understand. Because the algorithm will represent them as previous accumulation or distribution places in the marketplace and will mitigate their orders right there. Okay, we go down, we respect the order block right here, but we start disrespecting the order block right here. Once we see this, we do not need to wait for a market structure. As you can see, market structure is all the way here. But as soon as we see this candle, we can think, okay, something's going on. And it's more likely to go lower, and it eventually does. It taps into the swing low. Then after tapping into the swing low, it does a retracement where to this fair value gap, also where to this inversion order block. Goes lower, boom, disrespects bearish array. What are we looking at right now? Well, we're just looking at this order block. We would like, if it was in a good time, because right now it's 3 o'clock and we're not looking for trades at that time, but if it was a good time, we would be looking for shorts here. Price goes eventually down, it takes the liquidity, and after taking the liquidity goes up again, takes again all this liquidity, and eventually goes lower. Okay, that's pretty much it. Well, in today's class, we're going to be talking about mitigation block. Okay, what is it? Well, a mitigation block is pretty much on a downtrend, the last down candle before the ran up. Okay, before the retracement. In this case, which one would it be? Right here, this is our mitigation block. Once we get traded through it, this will become our mitigation block. Okay, once we trade through this swing low again, okay, that swing low will also become the mitigation block. As you can see, we trade through it, which is a down candle, this is a down candle. This will become the mitigation block. This will become now the mitigation block. Never touches. Okay, basic. where's the run up? Here is the candle. This is our mitigation block. Once trades through, we change bullish. Okay. And on the bullish side, which is a mitigation block, well, the mitigation block will be on the bullish side, all the up candles before they ran lower. Okay. For example, here we do not touch anything, but here, where's our mitigation block? Right here. We run, we touch it, we go higher. Okay. Once we go higher over here, where is the mitigation block? Mitigation block is right here. However, this is a bearish scenario because we're broken. We disrespected the bullish order flow, so change to bearishness. However, look at here. Here we have this change in delivery over here, right here. Okay, which is the up candle. This. So we return, we touch it, we go up. Okay. Here we could we could say that this is the retracement, because once it gets threaded through, we tap it again, we go higher. Because remember, we do not need to wait for this swing high to get broken for a change in delivery state. Once we see bullish order flow respected and bearish or disrespected, we can assume this swing high is going to be broken. And we can target all these highs. Let's look for more. In this scenario, where is down candle? Here, never gets tapped. It just goes lower. Where's the down candle before the run? Right here. Down candle before the run. So this would be our mitigation block. Gets tapped, goes lower. Okay? Where's the down candle? Right here. Down candle before the run higher. Mitigation block. We tapped into the mitigation block. Okay, where's the up candle before the run lower? Well, in this case, we do not care about here because this is a change in delivery state. Once we get broken through here and we start respecting bullishness, well, we do not need to wait for this swing high to get broken. However, once we retrace, where is our focus? Well, our focus is on the up candle. This will be our mitigation once it gets straight through. Mitigation, trades through it, again, taps into the mitigation, but eventually changes delivery state right here, and eventually goes lower. Same here. We're ranging, we change delivery state over here, from bearish to bullish, which is the up candle right here. We tapped, but we go a little bit lower to this imbalance, and we then resume higher. Where is the up candle before the retracement? This one. We tapped into it, we go higher. Okay. Then we eventually change delivery state because the bullish PDRAs are disrespected. This order block is getting disrespected right here. So where are we looking? We're looking for any bearishness. Mitigation block. We tapped into it, we go lower. Where's our mitigation block right now? Once we trade through here. This. We trade through it, we change. Then we go down. We go up. Where's our mitigation at this point? It will be right here. We never tap into it. Then we go lower. We tapped into it, but we changed delivery state. We go bullish. right here, so we wouldn't focus on this. Remember, something that I maybe not have mentioned, but we focus on which is the PD array. That PD array, I mean fair value gap, volume imbalance, order block, breaker block, whatever. We focus on which one is going to be the one that price is going likely to gravitate to use to displace. So if there's a mitigation block nearby, it's likely to use a mitigation block. If there's a fair value gap, it's likely to use a fair value gap. Let's go to a 15-minute chart so I can show you. 5-minute chart. We disrespect bearish PD arrays right here, and we respect this bullish order block. We go higher. Okay, what do we have here? We have a propulsion block. Propulsion block over here, and fair value gap over here. So we will be looking for something of this nature. Okay, this will be our focus. We tapped into the fair value gap. We go higher. Once price trades through it, where will our focus be? Right here at the order block. Why here? Because is there any fair value gap? No. So what is our array? This order block taps into the order block, goes higher. Also, it's a propulsion block, correct? Order block, propulsion block, taps, goes higher. Is there any order block, any volume imbalance, anything here? No. So what are we focusing? On the fair value gap. We could enter right here with our stop right here and target right here. I wouldn't enter this close to the target, but I mean, it's a possible entry. Okay. So in this case, where's our mitigation blocks? On the 5 minutes. Right here, it's gonna be a perfect example. We do not touch any down candles. We do not touch any down candles. We do not touch any down candles. But here we do. On these PD arrays, what are we respecting? We're respecting the fair value gaps. Fair value gap taps into it. Fair value gap taps into it. Fair value gap taps into it. Fair value gap right here doesn't really respect it. Taps into the order block right here. Respects it. Taps into the mitigation as well. Respects it. Goes lower. Goes lower. Goes lower. Goes lower. Respecting the PD arrays. Until when? Until eventually it starts accumulating lower, 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 lower. And now, where is the change in delivery? Once we trade through this order block, right here, at 240, we trade through the order block, we break structure, we tapped, boom, inverse, order block, right here. Order block right here. Taps, boom, rockets, bang. Taps into their order block and a little fair value. No, there's no fair value gap. Taps into their order block. What could be your entry? Your entry could be right here. Right here. And where would you be targeting? You will be targeting, well, these highs could be your target. Or you could target something of this nature, for example, which doesn't really get tapped, but almost for 226 for 1 pip. Okay, so that's pretty much a propulsion block. Here will be your propulsion right here. Propulsion takes the stop losses, goes lower, and then starts ranging, having kind of hard price action to read. Goes lower, takes the stop losses. Then we have displacement with disrespect bullish PD arrays. What is here? Fair value gap right here. This is where we are wanting to see price. We don't really want to see price go all the way down here because we already took the stops. We already manipulated the price right here, so we want to see it go higher. We don't want to see it go lower. Goes here, then goes higher. Okay, well, let's go to the next class. Well, right now we're gonna be talking about immediate rebalance. Okay, immediate rebalance is when the marketplace has a really explosive downside move, just like here, in which the market does this. Okay, the market does boom, rebalances right here, because imagine this is the candle and Tuesday hasn't opened. It's gonna open just like this. Imagine it's gonna be this. Let's get this. It's gonna look like this. This is gonna be the candle, right? That's gonna be the candle. So this is an imbalance at that moment. Right there, that's an imbalance. Okay, that's an imbalance. Let's get this so you can see. Okay, perfect. That's an imbalance right there. Do you see it? Right here. So we don't want to see price after it immediately rebalances everything. We do not want to see price stall over here. We want to see it every time it touches go down, every time it touches go down. Okay, that's what we want to see with the immediate rebalances. Now, something to take into consideration is the next thing. Look, let's go and see some immediate rebalances right here. Okay, immediate rebalanced. This is our imbalance, and we don't want to see price go lower. We just want to see it use this to go up. And if there's a fair value gap, we can expect that fair value gap to be left open. We can expect for price not to reach into the fair value gap anymore. For example, we had a little fair value gap over here. Okay, super little, but we can expect price to not go there and just to touch it and go higher. Okay, for example, I believe we have one fair value gap over here. We never tap into it. Why? Because there's an immediate rebalance here, so we don't want to see price touch and go higher. We just want to go and see it go quick, immediately go lower. Let's go to a 15-minute time frame. Let's go to DXY. Now let's go to GBP. Where's an immediate rebalance? Right here. Okay. We don't want to see price just go for this fair value gap. We want to see this order block and this immediate rebalance stay here. Okay, we want to see this order block respected and go lower. We don't want to see this because it's already balanced. There's also an immediate rebalance right here. As you can see, immediate rebalance. We don't want to go and see price go here to this BPR. We're not gonna go on there. Why? Because price needs to go quick. Okay, it goes quick because it already rebalances. Boom. We just want to go and see it go lower. Okay, let's look for more examples. Right here, yes, you can see there's no imbalance. Right here there's no imbalance and there's liquidity resting over here. So what do we see here? We see this as our immediate rebalance. Okay, you can see also we have this mitigation block right here. The move up touches the mitigation block right here, goes lower. Okay, we could do something of this nature, go to the 5 minute, look for something here. As you can see, this is a CB. We don't want to see 50% get traded through. Okay, we do this very shallowly, a little bit, and then boom, go lower, boom, 50% respect. What are we looking here? This propulsion block right here. There's a propulsion block, right? So we could enter right there with our target being right here. This could be our trade. Okay, we talk the propulsion, touches of order block, touches it, goes lower, touches it, propulsion right here, touches it again right here, goes lower, boom, takes the liquidity. Okay, as you can see, let's look for more immediate rebalances. Well, right here there's no any that I can see, except for maybe this one right here, which is this one, which price eventually chooses to go over here, although it doesn't actually take the liquidity at all. It leaves liquidity pending, but maybe the rejection block was tapped, and that will indicate a take profit. As you can see, rejection block was tapped, we go lower, we tap it again, we go lower, we change the delivery state, we go bearish, boom, taps, boom, 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 and later on we consolidate, we nuke, we take all this liquidity, and then we go higher. We do not take that high again, but maybe now we take the propulsion block from here. Here's our propulsion block right there, almost. Then we go lower, we tapped into it, we want to see 50% left open, taps, goes lower. After going lower, what do we have here? We have a displacement, fair value gap, that's our entry at the order block right there. Let's stop right there. What are we targeting? Well, we're targeting this low, and if there's liquidity pending, that liquidity, this is a big stop loss, so it's not the best risk reward, but it's a nice quick 2-hour trade. You could do something of this nature, but I would think it's better for you to have a more conservative stop loss. Okay, that's pretty much everything for immediate rebalance. Let's go to the next topic. Okay, now we were going to be talking about liquidity. Liquidity is resting at swing highs such as this and swing lows such as this. Okay, this is the liquidity, swing high, swing low. Also, there's liquidity in the imbalances. Why? Because imbalances are lower time frame points of liquidity. Look, this is lower time frame point of liquidity. This is the swing low that made the swing high. So an imbalance is a liquidity point, and you can use them for entries as well on the higher time frame. As you can see, imbalances work because they're liquidity points. Okay, and the same goes for these imbalances right here. We have this immediate rebalance, trades into it again. What's the likely? This, once liquidity is taken, if we have higher time frame bullishness, we can start thinking about a reversal. However, if we're bearish, we're thinking about continuation. But as you can see, what's the likely place for price to go? The liquidity, because market moves liquidity for liquidity. There we go, we take liquidity. What's likely now? Continuation or reversal, depending on the price action. This price action shows a little bit more of bullishness. Why? There's an imbalance which is gravitating to. It's touching an order block and reacts. We want to see right now either continuation or, okay, this is nice, continuation or price reversal. This is the reversal. Okay, no. Why? Because it took liquidity and it's closing above, which can indicate willingness to go higher. So you will go to a lower time frame and see whatever happens here. Once the price trades through this, remember this will be our breaker block. That's our breaker, that's our order block as well. And we have this immediate rebalance, so we would like to see price go there and then go higher. We don't want to see price go lower again. If not, we're wrong on the idea, okay? We will be wrong on this idea. Price is starting to go lower, which means we're probably wrong on the idea, okay? And it goes lower. It's consolidating right here. That's the important thing about being wrong or right on an idea, being the closest to your validation, because that way you don't wait for price to just go all the way against you. And whenever you win more than you lose. After taking the liquidity, like I already explained, price continues higher. Where is price likely to gravitate to? Right here. So what would you be looking at? You will be looking at something of this nature. An imbalance entry, your stop loss below the order block, and your target will be here. This is not a really good trade because it's low probability, in the sense low risk reward, but it's a possible entry. Okay, why? Because it respects the concepts that I already explained. As you can see, it goes there. However, it's respecting what? It's respecting the bullish arrays. You could have entered right here, okay, and look at the change of the risk reward. However, what's the probability if price is trying to displace higher and quickly, that it's going to trade this dip into your order, it's gonna fill you, you're gonna enter right here at the bottom of the price, and you're gonna get a 5 risk to reward entry in less than 20 minutes. I mean, it's not likely, but if you do manage to get it, because the concept is working, good for you and amazing. But many times if you try to get these greedy entries, you're likely not to get the entry, okay? But like I said, the concept is we don't want to see price trade through the order block. We don't even need to wait to place our stop loss all the way here. Look at this, that's terrible. At least here you go positive risk to reward. However, I wouldn't be taking this trade honestly, because it's not giving me enough risk to reward. Okay, once the liquidity is taken, we can expect price to reverse within a key time zone, which we're gonna see later on. And price eventually retraces where? To this swing low, and I'm pretty sure it's gonna be a 1 hour inefficiency. There's the 1 hour inefficiency for Valiant, but it never steps into it. 30 minutes, likely to be an immediate rebalance. Taps into the immediate rebalance, goes higher. Okay? So, liquidity is basically, let's take this so you can concentrate. Liquidity is basically inefficiencies and swing highs, swing lows. Okay? Also, the last type of liquidity is the rejection blocks. Rejection blocks are, like I already explained, the highest body of the candle. Okay? Rejection block is gonna be that. Why are they useful? Sometimes price is not going to take this, but it's going to take the rejection block. Okay? It's gonna leave this wick left on top untapped, okay? But it's gonna tap into the rejection block. There's where your liquidity grab happens, because many people are gonna start, once it goes here, they're gonna start cutting their losses. They're gonna start cutting their loss, just like I do. and it's the best thing to do, because most of the times it does eventually come for you. So if you're seeing price come here and invalidate your idea, you should get out of the trade. Okay, sometimes it's not going to go, but many times it's going to save you a lot of capital. Okay, because let's say you take your, for example, right here, it doesn't never come for the swing low, as you can see, but it taps the rejection block. Okay, it goes a little bit higher, and then boom, it takes the stop losses all the way this dip. Look at how deep. All this, boom, and then reverses. Okay, it takes the liquidity, then reverse. Same thing here. It takes the liquidity, then reverses. But the rejection block is another type of liquidity for you to take profits, or for you to understand where to get your invalidation zones, because many times it's going to tap into the rejection and go even lower or higher. So it's better just to get out of the trade sooner than later. If you can cut your loss soon, it's better than cutting your loss later, because it's gonna end up being a bigger loss. Okay, but yeah, that's pretty much everything for liquidity. Inefficiencies, like I already explained, inefficiencies are a form of liquidity, and also swing highs, swing lows. This is a swing high, swing low, takes the swing low, reverse, swing high, as you can see, takes the swing high for a little bit, then retraces where? To an inefficiency, which is a redeliver, immediate rebalance, accumulates, it never goes into this inefficiency, because we shouldn't see price really go lower than this, neither this, because all of these are immediate rebalances. We shouldn't see price just from here go all the way back here to go higher. It makes no sense. Why? Because we already took the stops. We already took these stops. Are we just going to take stops? Well, that's a range. That will be a range, and then we will be playing the trades like a range. We wouldn't be doing the trades just like a trend. We will be looking for range trades, which is liquidity to liquidity. Okay, that's it for liquidity. Okay, now we're gonna be talking about my market maker sell or buy models. Okay, market maker buy or sell models are basically, let's go to a blank chart. Let's go to a monthly. Let's reset it. Let's move this, and let's do this. Market maker buy or sell models. Actually, let's do this. What the hell? Perfect. Market maker buy or sell models. This is something really nice. Okay, let's look for this right here. This is a market maker buy or sell model. Okay, let's remove this. Perfect. This is a market maker buy or sell model. First impulse, accumulation. Second impulse, accumulation. Third impulse, distribution. And then we change to this. Okay, this is a market maker buy model right here. Let's remove this. This is the first accumulation phase, second accumulation phase, reversal, first distribution phase, second distribution phase, reversal, and it repeats on and on and on. Okay, you're probably seeing this in the market, and you see, okay, this is exactly how the market operates. Yep, That's exactly how the market operates, okay? It will induce liquidity once a higher time frame PD array is tapped. Once a higher time frame PD array is tapped, same thing over here. We can expect price to do a reversal, short term or long term, depending on the time frame we're looking at, because this is fractal on every single time frame. Okay? So, first accumulation, second accumulation, reversal phase, first distribution, second distribution, reversal phase, and so on. Let's remove this and let's go to the chart. Where's the higher time frame? Right here. Accumulation, reversal, okay? Reversal, first accumulation, second accumulation, remember they accumulate at the up candles. Reversal, first accumulation, second accumulation, reversal, this was a short accumulation, reversed after taking these stops right here. This was a long accumulation for a while, even years, 4 years accumulation. This was the first accumulation after leaving the range. I will consider this event, because this is a big range, I will consider this the reversal phase, because as you can see it's below the range. So this will be the reversal. Below the range, accumulate. First accumulation actually right here, second right here, and after taking the liquidity over here, this is the reversal phase, in my opinion. Okay, I could be wrong, we could head all the way over here. It's likely, I don't know. I do not control the markets, but I look in probabilities. Okay, this could be their second accumulation phase, but for me, in my experience, it looks more like a reversal. So we're going to get some distribution here, okay, above this high. We distribute, okay, then head lower. Okay, how can we know? Well, we have to start disrespecting bullish arrays. Accumulating something like this, distribute, accumulate, distribute. Here we can think, okay, this would be our reversal phase. We're at 98. That's how you see a market maker, and it's the same on all the lower time frames. Accumulation, accumulation, another phase of accumulation, reversal right here, expands, accumulation, accumulation, reversal, accumulation below these lows, first accumulation, second accumulation, and where is it likely for us to then explode to? These highs, and on the highs, reversal to go lower, reversal, accumulation, accumulation, then our distribution, reversal, then we just accumulate again, and then we reverse. But note something about this. Can you see here something, some pattern? The same places where price accumulated at, it's the same places it's going to try to accumulate at as well. It accumulated here, it starts accumulating there over again. It accumulated here, it accumulates over here again. Okay, it accumulated here, it accumulates over here again. Same thing here. Once we break through, we accumulate. Once we break through, we accumulate. Once we break through the zones of accumulation of a downtrend, then it accumulates there. What's the next zone? This was the next zone of accumulation. We accumulate over there. You can see this is the accumulation zone. We accumulate there over again. Then we distribute. We have our reversal right here below the lows. Where was our phase of accumulation? Right here. We accumulate again. Second phase on this down candle because they buy on the down candles. We accumulate over there again. Where was the other accumulation? There. We accumulate over again. And where's the other accumulation? Right here. This was a reversal accumulation. We accumulate over here again. This is the last, in my opinion. And I will take these stops. We're reverse for going lower. Okay? That's market maker buy or sell models. Okay, today we're going to be talking about retrade and retrace. Okay, what's retrade and what's retrace? Retrade is basically this. As soon as we see one PDA array fail, such as this would be a breaker block in this case. Okay, this will be a breaker block. As soon as we see a breaker block failed, and also we see an order block fail, we can wait for any retracement into this. If this is your higher time frame chart that you trade on, this will be how your trade will be looking. Okay, something of this nature. If you only trade on the daily. However, I trade on lower time frames with daily as my confluence for my higher time frame. So we're looking into lower time frame confluences, which will be this lower time frame breaker, and we will be looking for something of this nature, a 5-minute change of delivery. So we go here, we do sellers at the beginning of the market, and boom, we tapped into this order block right here, the order block for the move up. We tap into it, also the 1-hour breaker, and out of nowhere we pump on a nice time zone, which be London or New York. We pump right here. Let's say we do it here at this time, and then we get some kind of move like this. Okay, higher highs, disrespecting bearish PDA arrays. We're looking for an entry right here, for example, like this. And this. Now there's two of ways you can do this. Like I already mentioned, the rate trade, the risk. This, for example, we disrespect this bearish array. Okay, now we're bullish. We respect this bullish array, which is this order block as well, which if we check the 50%, it gets respected. And we immediately go up. We disrespect this bearish, and we respect this bullish array, which is an order block. And then we have this imbalance. What are we looking at right now? We look at this imbalance as an entry. And our stop will be over here, below this order block. What our target will be here. Okay? Now, this will be a retrade. Because why? It's just going up the order block without any real displacement, and you enter. Once one PDA array fails, you enter. Retrade, quick. And this will be a retrace. It goes all the way with institution sponsorship, which is institution sponsorship is pretty much speed in a time period, which is New York. This will be London close in a time zone with speed with inefficiencies, this fair value gap, and any retracement after the quick move has happened will be your trade. It will be something of this nature. Look at the risk reward, it's lower. Okay, this will be a retrace. A retrade will be this. As soon as one PDRA disrespects, we don't need to wait. You could wait for a retrade of this order block and put a stop loss at this nature. Okay, you can also do this retrade. You don't need to wait for this candle to happen. As soon as the candle opens and taps into it, you're expecting it to impulse. As soon as it does it, you're just thinking, oh, okay, this is the manipulation of the candle, then we're gonna displace higher. Okay, that's a retrade. This is a retrade as well. This bullish, bearish order block fails after we take stop losses, all the stop losses. We impulse high in the time zone, which is London, New York, my bad. What are we looking at? We're looking at this BPR, correct? We enter right here, where stop loss at the order block. We target the highs. And if there's more liquidity, we target those liquidity, but I believe these highs and that high, which would be over here. We tap into the high, and that's trade done. Okay, this is a retrade as well. You enter. A retrace would be once price impulses again. Well, you can enter where you can enter under inverse order block, and this order block that was the manipulation. There you go. Here stop will be at the swing low, and I don't know your target. It was already taken. I wouldn't take this trade honestly because liquidity was taken, unless we have a target such as this, which I believe never get tapped. It just goes higher. It taps this, and it doesn't go higher. It just goes lower, manipulates, takes all of these stop losses, and then it goes higher. As you can see, this is the exact same thing as I already explained on the market maker buy or sell models. We have all these lows, then we accumulate below the lows on a time zone which is London, right here, reversal, below the lows, big impulse. Where is your retrade? Right here. This is your breaker block. As soon as it fails, you enter on the breaker here. Stop here. What are we targeting? We're targeting pretty much these highs. And that's straight down. Okay. Retrace will be something of this nature. Once price showed again willingness to go up, you enter the order block at this order block as well, because this is the one with the big body. And you just trade whatever you believe your target is. But if I don't have any target, I'm not entering. I need to have a target to enter. Okay. That's pretty much everything about retrade and retrace. You can use whatever you like the most. For beginners, maybe use retrace. Something of this. As soon as it goes lower into a fair value gap, you're looking for longs. Okay? And maybe for one advanced student, as soon as this order block, after taking these stop losses, as soon as it fails right here, you can use it as an inverse PDRA. You do not need to wait for this swing high to be broken and for it to have a breaker block. This was a breaker within a fair value gap entry, and it went higher. However, an advanced student could catch all of this movement. Order block fails, inverse, and we're targeting these highs. Okay, it managed to not be any emotional once price did this, which I honestly would have escaped my trade before NFP, because we do not even know if it was going to manipulate all the way here. Well, you can just, once NFP is about to come, you can close your trade here, 1 hour before NFP. Right here, you close your trade, you're done. NFP happens, you look for new setups next week. Okay, That's pretty much everything, like I already explained. And you can see it works on every time frame. Retrade and retrace. Okay? I'll see you guys in the next lesson. Okay, in this lesson we're gonna be talking about kill zones, which are the time zones we can operate the market on. And I'm gonna explain what we can expect on these time zones. Okay. First, let's go to a blank space so you see it's the same always. Let's go here. Or let's go here. Even deeper. Let's go to a 50-minute chart. Okay. First time zone is the Asian kill zone, which is Asian kill zone is from Asia kill zone 20 to 0. Okay, Asia kill zone is from 20 to 0. I'm going to mark them with boxes, and it's most of the time zone it's a ranging market. As you can see, this is your Asian kill zone. It's a ranging market for about 4 hours. Okay, 4 hours of range. Now, then we have our London kill zone, which is from 2 o'clock to 5 o'clock. Okay, we can expect manipulation on the opposite side we're actually wanting to go. Okay, so we opened at 2 o'clock right here. Okay, at this candle. As you can see, volume comes there and it closes at 5 o'clock. This is London kill zone. Volume comes at this time period. As you can see, before going lower, we take the stop losses of the Asian kill zone. We take the stop losses, then boom, go lower. What is respected here? An order block, of course. It's not a random place, it's a specific place. So your order block is respected. Do you have any pending liquidity? Well, not really, except for these lows over here, which I believe they don't even get tapped. They don't even get tapped from what I see. They don't even get tapped because the liquidity was over here. So you could enter here for a second step lower, unless we do have some lows, which no, it's these ones that they don't even get tapped. Okay, we take the liquidity, so we take it right here. That's where your retrade is gonna be better. Why your retrade, you're asking? Look at this. Look, pay attention. Swing low is over here, okay? And this is also an order block, right? So your order block is failing. You can have this retrade. Now your order block is this one, as you see. It touches the order block before going lower. Then it goes lower. It takes these stop losses. It trades again. It goes one time deeper into this. Okay? Remember the market maker buy and sell models. Remember them. It goes deeper. It touches it. Okay? Then what happens? We have our next kill zone, which is New York kill zone. From what time zone to what time zone? 7 to 10. And this will most of the times either be a continuation of London or be a reversal from London. We open kill zone right here. we touch an order block. Okay, not random, we touch the order block, we go lower, where to take the stop losses. 8:30 is usually when the news come. 10. Okay, perfect example for me to show you. 10. We had a continuation. Okay, and then we have our last kill zone, which is London close from 10 to 11. Okay, this is London close. London close opens here and closes here. We expect here a reversal. This is most likely a CPI or FOMC situation from what I see, because 1 o'clock is most of the times FOMC, so it's a no trade day either, so it's okay. It goes, it disrespects its order block, then it uses it as an inversion place, as you can see, which is the low. The low is 85, 84, taps into it, goes higher. Okay, also we had this BPR, inverse fair value gap, BPR and inverse fair value gap here. We use that as well, but I'm not going to trade this. I'm just saying I'm reading the price action. We tap into inverse fair value gap, we go lower. We left this fair value gap, which eventually does get tapped right here before going higher. Okay, that's the kill zone. Let's go to the next day so you can see, and let's move this. One last example. Let's go to the 1 hour to move this quickly. There we go. So what does the Asian session do? Consolidation, right? Asian session consolidation. What does the London do? It's taking the Asian stop losses. Where are the Asian stop losses? Right here and right there. That's our Asian session. There we go. London takes stops, then goes to the opposite side. This was our rejection block. Okay, where's the next round liquidity? Over here, rejection block and the high. Okay, we touch the rejection, we touch it again. That's why I say you need to be cautious of the rejection blocks. Sometimes the highs are gonna be left tapped. Then what do? We go lower. What are we looking at? We're looking at this order block at a key time zone here, 7. 7 wants to take the liquidity prior to its session. There we go. We take the liquidity. This is failing. Unless we take these stop losses and then we continue higher. That's what we want to see. Rejection block tapped. Okay. Where are we looking? We saw GTs fail, but this is the one with the big body. We want to see 50% tapped and lower. If not, it's going lower. We take this from this low again. Now where are we looking? We're looking for either New York wants to continue lower or higher. From what I see, it's wanting to continue lower, although it's not showing fair value gaps, and fair value gaps are what show us if price wants to truly go lower. So we have to be cautious. As soon as we see these, we can start thinking that the long side is better. Right here, as soon as we see this order block, we want to see price hold there. Are we going to go higher or lower? I don't know why this thing is moving by itself when I'm not giving it the order. I don't know how to stop it. What my PC is getting bugged. Well, it's unlucky, but I believe you understood what the kill zones do. Okay, I believe it's TradingView, it's having some server issues, but there's no problem. Let's go to the real data at this moment so you can understand better without having these bugs. Okay, let's remove all the drawings. Asian session. Okay, here we go. Asian session, low and high. What does London do? London wants to rate the Asian session. What does it do later? It shows willingness to go higher with displacement. Let's go to the lower time frame and look for a change in delivery state. Here we have a broken structure. This was your entry right here. Right here was our entry. Okay, where will our stop be? Well, it could be all the way here, but I believe it's better to give it some breathing, which would be below the 50%, 9 pips, just like this. Okay, I believe this would be a better stop, because why? Because we're in a ranging market and we can expect maybe a quick pullback, but we also not want to miss the entry. Okay, if you haven't entered, what are you going to do here? You're going to enter, if the target's not met yet, you're going to enter at the order block, where with your stop here and your order block right here. Okay, this will be your order entry, and there you go. Okay, that's trade done. So I believe you kind of understand what's the matter. It's the same thing. It's time with market maker by models, with all the concept blended. London will do these manipulations, show strength. Then what can we expect at 7 o'clock? At 7 we can expect either continuation or reversal. In this case, 7 is going for the highs. So if we're going for the highs, we can expect maybe right now a real retracement, because why? 7 will take the liquidity before its reversal. Here what are we looking? We could get a quick trade, okay? Not something to actually really, what's the matter, like, not something actually to really hold. Why? Because it's screaming bullish. This is just a quick trade. You could do something of this nature. Okay, and there we go. 8:15 news, so know when to not trade, but we took the stops at 8:15. Okay, that's good, no problem. Then what were we doing? We're starting to disrespect bullish arrays. We want to see the next leg. Are we going to do some manipulation lower for these stops? Seems like yes. What are we looking at? Well, we're starting to for example, disrespect bullish, so we can expect some accumulation here. Why? Because this is the market maker buy or sell model. What am I expecting here? I'm expecting my stop to be here, target here. Actually, I'm gonna put my stop a little bit tighter because I want a better risk to reward. There we go. It touches our entry, the order block, and goes for the lows. That's our trade done. We could even target these lows if we really wanted to. Okay. Now it's looking like it's starting to disrespect bullish arrays, bearish arrays. So we think, okay, our target was met. So now we can switch sentiments and bullish. This is the array that was disrespected. I don't need to wait for price to go higher. I can just enter here as soon as we trade there. okay? And price goes without our entry. Unless we would have entered on this candle as a retrade once it went over it on this one at 11. At 11:05 we could have entered as a retrade. Very aggressive. Although I believe I wouldn't, because it's the end of a kill zone, and like I already mentioned, the time zones, we do not want to trade outside of a kill zone. But like I already explained, kill zones are very important. Remember, if you do not understand or you want to know the times again, go back to the video and study the time zones. Go to your charts, study the time zones. You're going to see that time is very important. You shouldn't be trading at any random time, even if the price might go your way or whatever. You shouldn't. Today we're going to be talking about central bank dealing range. Okay, central bank dealing range will serve to us as our prediction for us to see when the market might bottom or might top, if we are bullish or bearish. Okay, for example, here we can expect some kind of manipulation for the highs, for the liquidity. Okay, right here. Okay, we may expect it. So what are we going to do? We're going to see from, I'm looking at the time zone. Okay, perfect. It's gonna be here. From 2 o'clock, from the day before to the day we're looking. It's from 2, right here. From 2, no, that's not 2. This is 2, right here. From 2 to 8, we're going to see our range, small range. That's what we want to see. And we're going to take the lowest candle bodies to the highest candle bodies on the range at 8, which would be this. Okay, then we're going to project standard deviations. Okay, which would be this. Okay, we're going to project standard deviation, and we see where's the high likely to project at 6 standard deviations, or if we want to look for the high or the low, for example, let's say we wanted to see what's the probable low for this, because we're bullish, we will look at something of this nature. To a standard deviation, maybe even -1. It's 1.5. I'm trying to look for it. What's worse? 1.5. Well, let's remove this. 1.5. Where you can see it's the actual low. Okay, 1.5 is the actual low at 2 o'clock at perfect time zone. Okay, so this is the dealing range between 2 to 8. We measure 1.5 standard deviation. This is the low. We displace higher. Okay, we go higher, higher, higher. Then the manipulation comes. Then we displace lower. We tap where? To the same place where the liquidity was. Also it's a CB. And then we displace lower. As you can see, the price is trying to hold at 1.5 standard, and also where the low is. Let's go for more examples. This week, let's look for another one. This. This is perfect. We look for 2. Where's the highest high on the 2 and the lowest? Well, the lowest is going to be this body, and the highest at 8 is going to be this body. Okay. Where is likely for the high at Friday to come if we're bearish? Okay. Where is likely the market to extend the most? 3, 4, 3 standard deviation. It can, for a little bit, displace over the standard deviation. Also, something is the ADR, average daily range. As you can see, ADR and standard deviations work. The price may not displace more than the average daily range. It's for us to know where to get our profits and where is likely the high to form, so we do not miss most of our profits. Okay? As you can see, price goes into the daily range, taps into it again after taking the liquidity, displaces, offers an entry at the breaker, then here fails the CB, the PC fails, 50% gets traded, then we can switch bearish until when? Until one period rate at a key time zone changes, because this is a range. This is not a trending market. Okay. What do we do here? Same thing. Where's 2? Something to mention. If the price does something like this, we do not take this as the average range because it's really big. We want to see a small range. Okay? We want to see something of this nature. Where's 8? 2 to 8. 2 is here. 8 is here, the highest, and 2 the lowest. This is the lowest at 2. Or I don't know if this, yeah, this. Okay, we get some sort of manipulation right here for some kind of reason. 2.5, 3 standard deviation, almost tapped into it, and then we displaced lower. So we can assume this is the high of the day because some kind of manipulation happened, and then we displace. No real support, it's just shorting. Boom. Then we tapped into it again. What happens at London? London displaces lower, taps. What's here? What can you see here? Let's remove this. What can you see here at London at a key time zone? Right here. That's your entry. Where's your stop? It can be here or at this swing high if you want to be more conservative. And where's your target? This swing low. You could put the stop here because it actually shouldn't trade over there anymore. But if you want to be a little bit more safe, you can place it all the way here. In my opinion, it's better here because if it trades all the way here, it's gonna trade all the way here, and you're wrong on the idea, okay? Once it trades to this low where the liquidity is resting, you can get out of the trade, or you can trade all the way here to this gap, okay? Once the gap is filled, we're out of the trade. Okay, that's it for dealing range. Well, today we're going to be talking about relative strength analysis, okay? Relative strength analysis is for us to know when we should buy or sell currency that is correlated to another one. For example, when do we want to buy euro, or when do we want to buy GBP, or when do we want to sell euro, or when do we want to sell GBP? For example, here we have this. Let's put this right here. Let's put GBP. Okay, let's change the colors so it looks exactly the same. As you can see, there we go. Okay, we do a run lower. Look at the cursors on both screens. We run lower, then we run higher. Okay, I'm gonna change this to euro. Okay, we run lower, then we run higher. Okay, then this destroys the order block and the swing low right here. GBP doesn't. So we're looking that GBP is more bullish. So if we're looking for shorts, we're looking for shorts at euro, okay? At this point. So we're looking for shorts here, we short. Then what happens? GBP is displacing lower, while euro is ranging. GBP displays lower. Then we have an imbalance here, and right here, and an order block right here. So we're looking now for shorts on GBP. It goes lower. While euro took this high, GBP did it take that high? Nope, it didn't take the high. So which is high? Which is stronger? Euro. So we're looking for sells on GBP, and we're looking sells. GBP is placing lower, while euro is making some kind of retracements. Look, the retracements on euro are much bigger than GBP. GBP retracements are much smaller, okay? Right? And GBP is displacing lower, which would present us more profits, which means more money. And if we're looking days for a counter trend, because on our lower time frames we're bullish, we will be looking for buys at euro, okay? How else can we determine this? Look at this, look at my chart. Look, euro GBP. Right here, what's happening here? We're taking some highs. I already explained to you, if we're in a range, we care about liquidity. So here, it means that GBP is likely to be stronger, and it's stronger here. Once GBP touches an order block, it's placed higher. So we're likely to be weaker. Once it touches the rejection block, it is placed lower. So we're likely to be what? We're likely to be lower on euro, because this is euro GBP. So we're looking for shorts on euro. Once we take the liquidity, what are we looking? We're looking for euro to be bullish and GBP to be bearish. So we're looking for shorts on GBP. And look at this, GBP doesn't take the high, euro takes the high. And now we have this order block, which it did get respected right here. We trade down into an order block again. This is your retrade. You enter, boom, this place is higher, and goes bullish where? To the highs. And now what are we expecting? We're expecting GBP to be stronger. So we're looking for buys on GBP, and if we're looking for sells, we're looking for sells on euro. Okay? This is how you do your analysis of strength. And you can do also this with pairs such as AUD and CT, AUD USD, and CT USD. These pairs are highly correlated, okay? These pairs are highly correlated. As you can see, look at my charts. Look at how their movement is, and look how their chart is. It's the exact same thing. We touch a rejection block, okay? Rejection block, we go lower. We go lower. Where are we likely to go? Here. And once price goes for these lows, what is likely to happen? We're likely to go higher again, okay? Because this is a ranging market. Understood? This is how you get your analysis. You follow a crosshair, such as this, and you see the price action on your both correlated pairs, and you select the one that is going to offer you a better movement. And you can do this on lower time frames as well, okay, for each individual day. Okay, this was your analysis strength. Okay, now we're going to be talking about leading pair versus SIG pair. On a downtrend, what we would like to see is the following. Okay, we would like to see on a downtrend price eventually want to displace lower, right? And we wouldn't want to see price ran through short-term highs or swing lows or anything of that nature, right? We want to see price respect. Well, in this case, we can see that the following. We have this swing high, right? On GBP. Right here, you can see my cursor on the right GBP. GBP runs through this high right here and does this. And Euro does the exact same thing. Okay? So they're correlated right now. There's no problem. Then what happens? We displace lower and we displace lower. However, look, GBP is respecting highs, right? It's respecting. Euro is not. Euro is taking all these highs. As you can see right here, Euro is taking all these highs. And GBP all this time, it only took the high right here. Okay? So Euro is the weak, the SIG pair. Okay? It's the SIG pair. Then we go lower and lower and lower. And GBP, what is it doing? GBP is consolidating, taking highs, taking highs, taking highs. Every time that Euro makes a rally, GBP takes a high, and Euro is just continuing to tap order blocks, go lower, tap order blocks, go lower, tap order blocks, go lower. And GBP is stalling here, taking highs, taking liquidity. So GBP is the SIG pair, and we want to take trades on the leading pair that's going lower. Right here, what's happening? We go lower, and what does Euro do? Euro takes this high. GBP, does it take this high? Not really. GBP does not take the high. Okay, so GBP is now our leading pair, and our SIG pair is Euro. So we're looking for shorts on GBP. Once price trades through, we're looking for shorts here. Boom. Displacement, boom. Displacement, boom. You understand? Let's continue. There's this high on Euro right here. You see it? Look at my cursor. And now look at my cursor on the right. What's going on here? We're not taking that high. This is our leading pair. We want to short this because every time that we short it, it's going to have a low resistance liquidity, in the sense it's going to offer the sell side, all the short is going to offer without any issue. Without no issue. It's just going lower, 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 lower. Okay? It's going lower. Dying. And Euro, whenever there's an opportunity, Euro is going to take the highs because he's SIG. He wants the liquidity. Okay? In this case, we do take this, but this is not a swing high. The swing high is all the way here. It does not take any swing high. Okay, so this is still our leadership pair, and euro is our SIG pair. Then we display slower. We go up, we go down, we go up. Which one is the SIG pair? Well, right now we do not know. They're both synchrony, and there's one new bullish trend about for the short term to start, in my opinion. Okay, so basically what we use is the relative strength analysis on this. Okay, we use the relative strength analysis. I'm going to show you last examples: AUD/USD and NZD/USD. Same thing goes here. Can you see it? Which is the SIG pair? AUD is the leadership, NZD is SIG pair. Look at this. Look at this huge value to take the highs. Look at this. It's not making any higher high on AUD, and NZD is making a higher high. Same thing happened here. Look at this. We have this in the short term. We have this. This is because this was our SIG pair. Every time there's a rally, we're going to have a huge rally on NZD, and AUD is not going to show that. Okay? And each time we go short, look at the falls on AUD. Boom, boom, boom. Okay? Here they're correlated, but look at this. The SIG pair takes this high, and this doesn't. This has equal highs. Okay? And look at the fall. Look at this huge fall. Look, 2.54, 2.4. Okay. It doesn't really matter how much percentage, since the pair depends on how much the change is, but you can see with your eyes how much bigger the fall is. We fall, we break the structure, we change delivery, we tap into an order block right here, and we go lower. Where? For the liquidity. We take the liquidity, we go higher. AUD was, in this point, AUD was the SIG pair. AUD was the SIG pair, and here the leadership pair was NZD, because the shorts were winning every time. Right here it was the leadership. As you can see, it recently changed to the SIG pair being NZD and the leadership pair being AUD, but before, look at the price action. NZD was the leadership pair and AUD was the SIG pair. Okay, so take that into notice with relative strength analysis and with everything I already taught you, because this way it will save you a lot of money. You will know which pair to trade, which pair will make you more money, and which pair is going to be the best. Okay, that's how you're going to look. I don't know why it's not taking me back here. There might be a bug, but look at this, if it lets me. Look. We're taking the stops over here. Okay. But right here we're not taking. Look at this, it was the leadership pair when it was bullish. In bullishness, it didn't take this low. Here it took the low, it took the rejection block, going higher. But here it never took this because it was the leadership pair on bullishness. And on bearishness, this was the SIG pair. Look how it's taking the highs, taking this high, while NZD is making lower lows. then we have these highs. It runs through them aggressively. NCD is just tapping another block right here, because here is our swing high. Here was the other block, this disrespected. And look, it's having a much easier time going lower. And now it's having a much harder time to go lower. And NCD is going lower, AUD is going lower. Okay, so that was it for this lesson. And we're almost done with the curse, so let's go to the next. Okay, we're almost done with the curse. Now we're gonna be talking about one of the best trading tools that you will have for your bias, not for your entry, because this is not an entry tool, this is a confirmation tool. Once you do have a bias, you can use this as a confirmation tool. Euro and the bonds, they're pretty similar, okay? Let's do this. No, this looks terrible. Let's do this. CB1. I don't know what's going on. Trading views kind of pretty slow, so let's give it a minute. These are the treasuries. Okay. If you made it this far on the course, congratulations. You're showing strength. This is where the best comes. So it will pay off. Okay. As you can see here, look, these are correlated, right? Are they going all down together? Of course. Is there any sick pair and everything of that nature? Of course, this was sick pairs, because look how they're going higher, and look how this CB1 is going lower without any difficulty. It's just going lower, 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 lower. And these ones are having some kind of issue, especially CF1. It's the most severe. It's taking stop losses every time it has the opportunity. It will knife you down. Okay? If you're looking for counter trades, then you go for this one, because you're looking longs. But if you're looking for trend trades, which is shorts, then you're looking for this one, CB1. But look at this. This is an SMT divergence, smart money technique divergence. We have a low, we have a higher low right here, and what do we have here? A higher low. Okay, if these assets are correlated, then why is this making a lower low and these ones are making higher lows? Because there's been a massive accumulation down there. I'll show you an example of real data of what I'm expecting with my bias. Okay, look at the correlation. Look right here. Okay, right here. You see? CB1 was making lower high. This was making higher high. These ones were making higher. Actually, no. This one also made a lower low. So lower low, higher high, and lower low. And lower high, my bad. And we're in an accumulation above previous highs. Okay, so we're thinking, okay, there's an SMT divergence above liquidity. This looks kind of curious. This looks like a manipulation accumulation of our market maker buy or sell model. In this case, it's a sell model. So anytime we get a displacement of this range, or a PD array such as this bullish order block is respected, and we trade through the range, I'm expecting some kind of shorts. And what does happen? Market goes lower. Okay. We understand. look at this right here. There's no SMT divergence right here, right? All of them are making higher lows. Yep, okay, perfect. Let's look at Euro. Sorry, my bad. Let's look at Euro. What is Euro doing right here? Euro is making higher lows. They're correlated, it's okay. What's doing GBP? GBP, it's making higher lows. What's doing CHF? Ooh la la! CHF, it's making a higher high right here. It taps into the high. Okay, we have one divergence with a highly correlated asset. What else do we have here? Let's go to DXY. What is DXY doing right here? Can you tell me? DXY right here, 21 of October. It's a higher high. Okay. What is Euro doing that same day? 21 of October. What is the other day? Right here. It's making a higher low. So we have a divergence right there as well. And we're starting to respect bullish arrays. So we're thinking, oh, there's a massive accumulation below these lows, and we're likely to reverse. Understood? We do not just look at the divergence and put a trade. We have to have a context behind it, such as this one, that is happening right now. We're below these lows. Right here, there's a divergence. So it's likely for us, if we start respecting bullish arrays, to make an expansion upwards again. Okay, I'm not calling any bottom. I don't want to. I don't need to. There's still liquidity down here, it's true. And it will be, in my opinion, the probable bottom. But in the short term, weeks, it's likely to at least give a retracement. Where? To the bullish order block, right here. To the bearish order block, my bad. Right here. And it's a nice trading opportunity for us to capitalize on it, okay? So that's it for SMT divergence. You can look for it on any asset. I will show the last, okay? Nasdaq, and this is it. Okay. US 500, USD, SPX then. Okay. Oh, ooh la la. Divergence right here. Lower high, higher high. Right? Can we see this market? Are they not extremely correlated? I'm looking at them, they're literally the same market. Which was the sixth pair? SPX is making higher highs. Nasdaq, it's not really. Look at the down. Boom, down. This was a sick pair. What's happening here? Look. You see? Let's go look. We have this divergence, right? That I already showed to you. Let's look to another one that is highly correlated. You're probably knowing which one I mean. Look, we had the divergence as well, right? We make the lows as well, right? They're all correlated. So we had a divergence right here, which indicates above highs accumulation, and we're looking for shorts where specific on Nasdaq. Anytime we get a displacement, fair value gap, we enter short. Where's our target? On these lows right here that had the liquidity, which eventually gets tapped, and it's also a nice round number, which is 10,000. Okay. Now look at this. What are we seeing here? Can we see anything? Look. In all this rally higher, they're all running together. They're all correlated, right? Now let's get a closer look. Look at the weekly. What are we seeing here? The Dow, it's running lower, okay? Dow is running lower, while these ones are on a consolidation. So this is the relative strength analysis, like I already taught you, okay? Also, let's take a look. Can we see something here on the daily chart? Well, we're going higher. What's going here? Look, we had this order block all the way here. We disrespected, then we changed bullish for a while. Okay? We tapped into the rejection, was placed lower. And while Dow is nuking, and SPX is nuking, Nasdaq is in a consolidation. So why would you be looking for shorts on Nasdaq? It makes no sense. If you know you're bearish, you're looking for shorts on DAX, on Dow, or on SPX. And if you're looking for longs, you're looking for longs on Nasdaq, because it's the sick pair. It's the one that's not going to displace higher, lower. But whenever it's going to displace higher and have a bullish wick, oh, it's going to displace really big, such as this candle you can see right here. Okay? Look at the order flow. Dow is clearly bearish. Now let's look something like DAX. Can you see the market maker buy model or sell model like I already mentioned? We take the stop losses, we distribute. What's likely to happen here? Well, we're going to accumulate where? Where did we accumulate? Right here. We're going to reaccumulate, then we're going to displace lower, reaccumulate. I'm not saying we should get all the way here. I'm not saying that, but it's likely to. Okay, at least here for the liquidity, because if we go to a monthly chart, I don't really use DAX for SMTs, but the DAX is making a higher high, and these ones are not really making a higher high. Okay, now let's go to the FTSE. FTSE is making a higher high as well, and the American indexes are not. Am I bearish on American indexes? Well, order flow is on the weekly. Let's remove this. Order flow on the weekly, it's 100% bearish without a doubt. We disrespected this order block. We disrespected, well, we're actually respecting this fair value gap. But we still have liquidity over here. We never tapped into the breaker unless you did a retrade and not a retrace. Once it trades here, you enter on the retrade, your stop will be something like this, your target will be those highs right here, and that's your trade done. You don't necessarily need to target these highs. Okay, so that's it, and I hope it worked for you. Well, for the past class we're going to be talking about psychology. Okay, I have some tips for you, which is pretty much focus on what you see. Okay, I'm going to write them down with text. Focus on what you see, not what you think. That's tip number one. Don't have something very biased that will not let you see what the market is screaming. Let the market tell you what it wants to do and react to it, okay? Also, don't judge yourself by one outcome, if not by 100. Do not think in one, think in 100. Do not think what happened, this is what I am. Think what happened in the 100 is what I am. Think long term, okay? Also, be disciplined. Know when to execute and when not to. Okay? Know when to do nothing and know when to do something. Okay, that will prevent you a lot of problems, and it will make you trade less and have more free time. And the last two, in my opinion, would be improve every day. Do not be satisfied. You have to every day learn something. Learn something. That's it. Learn something. Okay. And especially from the mistakes. Okay. And my last tip will be, honestly, like, be real. Know what you're doing wrong and know what you're doing good, and continue to do what you're going to do, and stop doing what you're doing wrong. Okay? Those are my 5 tips. Do more of the good, less of the bad. Focus on these things, and you will make it eventually with time and effort. Okay? That's it. I hope you really enjoy this course, and I'll see you guys on the next one. Okay? Talk to you later. Remember, watch everything, study, watch multiple times, watch the live markets, annotate, learn, never stop learning, and be humble. Do not think because you made it one time you are the chief. Stay humble, learn everything, and continue to be a market servant, and the markets will pay you. Okay? Talk to you guys later.